Hi, I'm Ryan Hanna, Chief Investment Officer at Cambridge Trust, a division of Eastern Bank. 2025 is off and running, and so are we, with our outlook of what you could expect in the next few months from an economic and market perspective. With all the political noise that's surrounding us, it's important for investors to stay focused on the fundamental day-to-day flow of information that shapes our investment thinking. Fourth quarter corporate earnings, a healthy labor market, softening inflation, and stability across the interest rate spectrum matter just as much as the politics at play, but will likely take a backseat to the political news cycle in the short term. Our job is to see the forest through the trees. Leading up to and following the election of President Trump, longer-term interest rates have moved decisively higher, notwithstanding 100 basis points of cuts in the Fed funds rate. This is partially due to President Trump's pro-growth agenda, the expectation for higher nominal growth in 2025, and the potential for higher levels of inflation in tighter monetary conditions. Interest rates, the US dollar, and inflation expectations have increased in anticipation of President Trump's economic agenda. Following a near 45-year bull market for bonds, bond yields hit a low point in 2020, but a higher path is emerging. This trend change is likely to ebb and flow over the coming years, but given the levels of federal debt and concerns with the deficit spending, we expect interest rates to remain elevated for some time. Higher interest rates are seen as a headwind for equity valuations and the housing market. U.S. 10-year Treasury rates above 4.5% have also represented a red line for risk in the current bull market. So we are mindful of the interest rate path that lies ahead. Across the globe, uncertainty remains elevated as investors gauge the evolving U.S. trade situation and the status of our relations with countries around the world. President Trump has frequently talked about imposing blanket tariffs on virtually all of our trade partners. However, most believe this is merely a negotiating tactic to get greater concessions from trade partners. A more plausible scenario would be gradually implemented targeted tariffs that apply to every country, but only cover a handful of critical imports. This would be a shift from President Trump's 2024 presidential campaign plans, but would likely be viewed by markets as a more pragmatic approach to instituting higher tariffs or negotiating for other concessions. Further, at his confirmation hearing, Treasury Secretary Scott Bessent provided a roadmap for understanding Trump's trade policies, noting that tariffs will serve three distinct purposes. 1, addressing trade imbalances. 2, raising revenue for the federal budget. And 3, pursuing policy goals, such as more liquefied natural gas exports, immigration enforcement, and more NATO spending. Despite the uncertainty that comes with a new administration, the U.S. economy continues to march forward and shows little sign of slowing. The non-farm payroll report released on January 10, 2025, showed the U.S. economy added 256,000 jobs during December, significantly higher than the consensus of 165,000 that was expected. A vibrant labor market with an unemployment rate of 4.1% and strong wage growth of 3.9% helps to support ongoing consumer spending trends. In December, U.S. retail sales rose 0.4% month over month, with the retail control group rising 0.7%. This is consistent with the Fed's Beige Book, which reported solid holiday sales. As a result of ongoing economic strength, we do not expect the Federal Reserve will announce any additional rate cuts. For the first time in years, the Fed has dry powder at its disposal should the economy slow, or if the job market sees a dramatic slowdown, we would expect the Fed to support the economy. It's unlikely that consumer prices will fall from current levels, and we are likely in a period of sustained higher prices. However, We are encouraged by the most recent Consumer Price Index report for December, which showed a deceleration in service inflation, specifically in shelter costs. While the election uncertainty has been resolved, policy questions will linger for some time, and the potential for a greater degree of economic uncertainty and higher volatility remains elevated. Despite these considerations, we expect slowing but still healthy levels of economic activity in 2025. GDP growth is above trend and consumer spending levels are firm. We believe the job market will continue to move back into balance and the unemployment rate should remain below 4.5%. Inflation will stay above the Fed's long-term target of 2%, and we do not expect any additional rate cuts until mid-2025 at the earliest. For now, Cambridge Trust is bullish on corporate revenues and earnings for the S&P 500, expecting double-digit earnings per share growth in 2025 and possibly into 2026. While interest rates are higher and likely to remain elevated, we do not believe this will derail the economy or markets, but may make the path somewhat volatile. As 2025 moves forward, our team will continue to stay close to the financial and economic opportunities and trends it brings, providing you with robust content focused on current wealth and banking insights. Discover more insights at cambridgetrust.com.